Welcome to Real Estate Radio Live, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Joe State. You can tune in and listen to us a couple different ways. One is on your radio, 𝗘𝗀𝗡𝗃 1220 AM. You can also listen to us live online at 𝗘𝗀𝗡𝗃.biz. You can follow us anywhere if you download one of those apps. And we have a podcast program now. Really excited, getting more and more information out to more avenues, channels here for you. More information if you want to go to 𝗟𝗓𝗡𝗃.com and download those podcasts and subscribe to it. You get the shows, take them anywhere, listen to them at any time. Again, that's 𝗟𝗓𝗡𝗃.com. A couple of different ways. Live show, you could communicate with us today during the show at any time. One is a toll-free number if you want to call in, 1-800-516-1220. Also a live text line during the show, 408-838-9060. All right, let me invite my guest in, Mr. Kris Hudson. He is a staff reporter for the Wall Street Journal. We were lucky enough to have on Kris. I think, was it a couple of months ago we had you on, Kris?
Yeah, definitely 2 months ago.
Yeah, welcome back.
Yeah, thanks very much. I appreciate it, Joe.
Yeah, it's always good to have your updates on the market and, you know, specifically what's going on. Today we're going to, Kris is good enough to give us some time. We're going to talk about the labor shortage impact on housing. And he follows this information, obviously, as well as anybody and reports on it. And on a regular basis, I would suggest that you follow, too, is what's the best way to follow your work? I think, is it Twitter that the best way to follow your work there, Kris?
Yeah, probably the easiest. That's just at Kris Hudson, WSJ. But it's spelled K-R-I-S. My mom had a thing for K's. So.
All right. Well, let's. Thanks again for joining us. Kris has been writing for the Wall Street Journal has it been 2005 since you joined them?
Yeah, 10 years.
Yeah, 10 years now. And you're. And what specific area, if you could remind us kind of what you cover, what you write about, and some of the specific areas that you work on there with the Journal?
Well, I've covered real estate for the Journal for the past 8 years, but really switched over in mid-2013 from covering commercial real estate to now covering residential construction. So
Great. Okay.
Pretty much the new home market, be it in single-family for sale housing or condos and sometimes rental apartments.
Great. Very good. So we're going to talk today a little bit about the impact of the labor shortage. And so maybe we could start. Tell us a little bit about, the topic today, the labor shortage and the impact on the housing market. Maybe you kind of give us the 30,000-foot overview of kind of what the labor market looks like and how that impacts the overall real estate market.
Good point.
The housing market.
Punchline first. What we are taught to do as journalists: tell people why it matters to them, because it may not be all that easy for some people outside of real estate to understand why it matters.
That's a good
there
point.
Aren't a whole lot of framers or tile setters available. Basically, it means it'll be another force pushing home prices up ultimately, and sometimes delaying projects, which in itself pushes prices up. If you're in the market looking at buying a newly built home and you're going to buy one that's basically dirt and is going to be built while you wait for it, you're going to want to be cognizant of this, because it's is highly possible that you may run into some delays almost in any market you're in these days, because certain skilled tradesmen are in such short supply. So what we've got here is right now most builders are saying that a labor shortage has become really acute. There has been a shortage off and on for most of the housing recovery, but it's gotten a lot more severe this year because the new home construction has finally started to ramp up. But residential construction labor ranks have not. For instance, we're at right now residential construction spending in the U.S. is at about $36 billion, which is at its highest monthly total since late 2007. But meanwhile, residential construction employment is still about 32% below its peak. And why we sort of ended up with that is as everybody knows, and I remember saying this a lot last time, your listeners know how bad it was during the downturn. I mean, it was just their adjectives don't do it justice. But it was really terrible for people in the construction trades. I mean, their jobs went away quickly, and they didn't there really wasn't a lot of growth in that industry for 3 years or so. So a lot of people left that industry, went elsewhere, maybe just retired in total, and they haven't come back. And that's why the ranks, they have not been able to recover as quickly as needed. And on top of that, they haven't done the best job as an industry of recruiting younger people into that to sort of backfill, to rebuild the ranks. So that's why we just, at this point, with many other factors, not enough people to ramp up as quickly as sales are going.
Well, that's this is interesting dynamic, and thank you again so much for really clearing this up and really doing a good job at articulating the difference, because I think most people, Kris, we see construction's up, as you said, new home starts, all this stuff. We're now seeing all this new construction all around. So most people would automatically assume, if you don't know, right, that must equate to a bunch of jobs being added all over the place.
Yeah, I mean, it equates to a bunch of job openings, for sure. Not necessarily, with a lot of people to fill it. Now, if you're looking at, so what are the causes of this? I think I found, as I spoke to as many builders and economists and other people as I could, to try to get a consensus around it. Because with every economic question, there's a lot of different causes, but you want to try to find a consensus around 2, maybe 3 main causes. And here we ran across, foremost, almost everybody agreed that training and recruitment has to be better in that industry. And I think it's going to be a process of who's going to pay for that, who's going to go through it. Sometimes the industry pays for it itself. In a lot of cases, it may be that government needs to come in and somehow help schools to rebuild their shop programs, their wood shop programs, or whatnot. So everybody agrees on that. The 2 other far more controversial topics, which we could talk about forever, are immigration reform. A lot of builders and contractors say immigration's tough right now. A lot of guys who used to work here who went back abroad during the downturn have not come back. They may have found better work abroad, or it's just too much of a hassle, be they legal or not. So that's one thing that, it's almost and that's another can of worms that might be tricky to open up. I don't really take a position on that one. Another one that's somewhat controversial is pay. And legitimately, the thing with the construction is commercial construction is a little more skilled, and those guys are paid a decent amount above your average U.S. wage. But residential construction is really almost right in line with average U.S. pay. But when you think about it, that's not enough. People argue, and there's a good point to be made, that those residential construction jobs need a premium because that's backbreaking work, and it can be fairly dangerous work. If a guy's going to make the same amount of money, maybe even a little bit less, working inside at a hotel or working, at Home Depot or working somewhere else, he's going to go for that because he doesn't have to work in the boiling sun and the rain or whatnot. So, even contractors themselves are saying we need to pay these guys more to attract more people into the business. Now, that, of course, ultimately leads to higher home prices if that comes to pass eventually. So those are the 3 main causes that we came to.
Wow. That's real good. That's good stuff. And isn't, there's so much to this labor, isn't there? I mean, in terms of there's so much conversation and talk about how, the big downturn that we all know about, as you had mentioned a few minutes ago, and what that did to the labor market. And some would suggest that, a lot of these jobs will never come back again. There's new job creation. There's the whole, the high-tech push and really where jobs are being added. And this is going to be interesting how this plays out. How do you see, I mean, I know you're not you report on this and you're an expert on this on a regular basis, but how do you see this playing out maybe over the next, 2 to 3 to 5 years with the labor market and as it relates to what we're talking about now?
Well, over the in a 5-year time frame, it's actually a pretty short time frame, as you know. I would imagine that what will happen is wages will have to be increased in order to bring more people back into the industry. Maybe there's some type of immigration reform. Who knows? I mean, we have an election next year, and that'll go a long ways towards determining that. But they're going to the short-term fix is to raise wages. The longer-term fix is to rebuild that training and marketing component, and that's going to be a state-by-state thing. I don't think you can do that nationally. It's almost a market-by-market thing. In some businesses, I think Commercial construction may do a little bit better job of it because it sometimes tend to be more of a unionized workforce where they have their own training programs. Residential is almost not unionized at all. So in some cases, it's up to the employer if they can do that or whatnot. Some employers want to be able to form co-ops or get together where they can form training partnerships. But I think in some states or maybe the federal laws, there may be some restrictions on that they'll have to lobby to get eased a little bit so they can pool resources to train workers. But like I said, short term, raise wages, longer term, and the more solid solution is to do a better job of training and recruiting.
Yeah, well said. If you're just tuning in, this is 𝗘𝗀𝗓𝗏 with the Real Estate Radio Live, and we're joined on the phone here for the first segment, maybe the second segment, depending on time and that we get through here with Kris Hudson, who is a staff reporter for the Wall Street Journal. We're talking specifically about really about the labor shortage and the impact on the housing market. And Kris has done a great job at articulating this and breaking it down in terms of, most of us are driving around and looking around. We're seeing all this, and we keep hearing construction's up, which is true. But then as Kris describes, labor's down, and there was some reason. He's describing some of the reasons for those. So good stuff, good information. If you have any questions for Kris or me, a couple different ways to reach us. The live text line, 408-838-9060, if you'd like to text a question to one of us, or if you'd like to get a call on the line, 1-800-516-1220. We're going to take a break here in about a minute. Kris, can you stay for one more segment?
Sure, that's fine. Yeah.
Okay. Yeah, so when we come back, what I want to do is talk a little bit about what does this really mean to the consumer? In other words, the delays. We'll talk about specific, what does it mean? Higher costs, obviously. Maybe we could break that down and then get into some more details about some of the builders themselves and, what they're doing, maybe certain areas. So we'll cover those things when we come back.
Yeah, sounds like a plan.
All right, this is 𝗘𝗀𝗓𝗏 with the Real Estate Radio Live. Again, we have on the line here for the next segment, Mr. Kris Hudson is a staff reporter for the Wall Street Radio Live. We have Kris Hudson on the line, who is kind enough to join us again. He joined us a couple months ago, and it's great to have him every couple months if we can, depending on his time. He's a staff reporter for the Wall Street Journal, covers real estate, specifically the new home builders and new construction. In the first segment, Kris talked a little bit about the shortage of the labor industry and what's that doing to the effects of the housing market. And so now we're going to talk a little bit about what does this really mean to the potential homeowners, because there is an impact. And so I'd like to spend this segment, Kris, talking about the bottom line is how does this affect the consumer when they're out looking for a new home? And there's so many different ways this could affect them. If you could share with us a little bit about how you see that shaking out here.
Yes, good point. And we talked a little bit already about rising costs, which higher labor costs mean higher home prices and whatnot. Delays mean higher prices because the builder has a higher carrying costs and whatnot. Mm-hmm. But I think another thing that buyers and their realtors and whatnot will need to be even more cognizant, even more sort of aware of in the coming months is the heightened potential for delays. So the builders that we talked to, we've heard a lot of different things. Even a builder that reported results today said they're delayed an average of 5 days, which may not seem very long, but it's a full work week, and that's adds costs. I'd even heard from some smaller builders that anywhere up to 40 days of construction cycle delays at this point. Mm-hmm. So that, if you're sitting waiting for a house and you need to sell your other house in the meantime, or more likely you're renting somewhere in the interim, that can be a big problem. As many people know. So you need to be aware that could happen. And usually in the past, sometimes if you have a delay like that, the builder will offer some type of concession, be it an upgrade on your counters or help with your closing costs or something to placate you and to keep you from leaving. But we got to remember in this case, we're still in a rising price environment across most of the country where that builder, if you walk, the builder can turn around and sell that nearly completed home for probably more than you had it in their contract for because the price has risen in the meantime. So the builders really don't have to, they don't have financial incentive necessarily to offer you something to placate you, to keep you around. I spoke to one builder in South Carolina who actually had a couple people who their homes were delayed, and he put them up in the Hilton Garden Inn for a month or two until the house was completed.
Mm-hmm.
He did that more because he was a good guy. He was doing the right thing. There were people that had relocated into town and had nowhere else to go. Now that's going to happen with good people, with good builders and whatnot, but sometimes that might not happen. So people need to be aware, factor in that increased possibility of longer construction time.
Yeah. The other thing as you talk, Kris, that comes to my mind, of course, because this is my area of business, is home financing. So interest rates. This is another factor that could cost the consumers. We all know, or if we watch, rates again are really good. But the thought is that, by the end of the year, certainly the first part of next year, we'll probably see them come up. Again, it's anybody's guess, but most of us, as we watch this market, there's a lot better chance that rates will go up than they will stay or come down. So this is another cost associated potentially with the delay, right?
Yeah. You want to make sure you lock that rate in as early as you can, so you don't have to deal with that. But it could be in one of those situations if for some reason you walk from the house that because it's taken too long to build, then you're going to have to turn around and buy some other place, and the rates may have gone up.
Mm-hmm.
I think, as you and I have probably discussed before, I don't think we're going to see a sharp rate increase. I think that
I don't think so.
Obviously, they've already illustrated that they're going to take a very cautious approach to it. So it may. I don't know if we'll see more than a quarter or half a point in the next year or so. But it's a good point. Regardless, that sometimes can end up being a lot of money, especially if somebody's buying based on their monthly payment.
Mm-hmm. Other than the the labor shortage, and obviously there's always challenges, but the construction, the builder industry in general, some of the big builders out there, are they optimistic overall from the investment world and just in general? Are the big builders seeing, Kris, as this is a good time for them over the next 4 to 5 years? We should see growth. What's kind of the overall sense in the marketplace for builders?
I think it is. Most of the time you hear builders saying we're still in the early to mid innings of this recovery.
Okay.
And the economic data would seem to indicate that's probably accurate. Home construction numbers have a long way to go before they get back to normal levels. A lot of people talk about a lot of pent-up demand out there, and I think that's mostly represented in adult children still living at home or doubling up with one or more roommates, which is happening. But employment has been increasing, wages have been increasing, and there's evidence that those sort of would-be first-time buyers are starting to come out of the woodwork. I think the difference is they may have different preferences in exactly what they want to buy. They may not want to live out in the exurbs, out on the fringe. They may want to live in closer in, sort of smaller housing, which is understandable. But it certainly seems like there likely is some pent-up demand, and there is room for the industry to keep expanding. And I think of late, right now, we're in the time of year where builders are usually focused more on completing constructions of the homes they sold in the spring. So the fall is not a big time for sales necessarily, but sales are still pretty strong, even for this time. Like Pulte Group, which I'm sure builds in the Bay Area,
yes, they do.
In Northern California.
They do.
Pulte reported today their orders were up about 8%, which for them was fairly robust. And of course, their closings were down 6%, mostly because of the labor shortage. And that was reflective of other builders that have reported these days. Sales are going pretty well. The concern in the fourth quarter is getting those homes completed and closed on time. And I would imagine that going into next spring, they're going to be pretty optimistic as well, because we're still seeing pretty strong job growth, and wages are starting to revive a little bit. Interest rates probably won't be dramatically higher. So most of the really important things to housing are fairly solid right now.
Okay. Well, we got to cut out. Kris, again, what's the best place to follow you? All this wonderful information you report on, is that, if you could give it out to the listeners one more time?
Sure. It's Kris Hudson, WSJ on Twitter. So that's KrisHudson, WSJ. And, or you could just check out on, Google me, on the Wall Street Journal page. So I appreciate it again, Joe. Great show.
Yeah, thank you. A lot of great information. Thank you for spending some time with us today, and we'll definitely have you back. Mr. Kris Hudson with the Wall Street Journal was kind enough to spend some time with us. We're going to take a quick break and come back, and we'll continue with Wall Street Journal covers the real estate area, specifically construction, new homes, and gave us some great insight on the labor shortage, the impact of that labor shortage that has on housing. That really does a great job of reporting. Follow him. Great read on a regular basis. It's Kris at Kris Hudson, the Wall Street Journal, and that's Kris with a K, 𝗪𝗓𝗓HUDSON on Twitter. Does a great job of reporting for the Wall Street Journal. He's kind enough to spend some time with us every month or so to kind of give us an update on what's going on. So the next couple of segments, I'm going to talk about interest rates. Going to give you a quick update just because I want to stress two things right now. If you've been listening to the show for a while, when I give you updates on things, we follow this on a regular basis. Rates have come back down again temporarily, and I would encourage you out there, if you're listening, take advantage of them. They're below 4% again, depending on the money, 30% fixed, depending on credit scores, loan to values, those types of things. They're below 4%. For 30-year money, 15-year money is in the low 3s and even in the 2% range, depending. And jumbo financing is down just as aggressive with the 30-year money as conforming. So two things. One, I'm going to throw out two alarms or kind of alerts for people here. If you have not consolidated a first and second, now would be a great time to do it. I am doing a lot of these right now, helping people consolidate a first and second. The reason why is those seconds are going to be coming due. They're coming due for a lot of people. They're amortized for 30 years, but they're fixed for 10 years on these seconds, these equity lines. And let me tell you, when those things adjust and recast, they will shock you at the payment. What most people don't know is they think the interest rate, most of them have interest-only payments, okay? So what most people think is, well, not a big deal. It just goes to a principal and interest payment, but it's amortized for 30. No. Don't make that mistake. What happens is if you have a 30-year amortized home equity line, it's fixed for 10 years, when it recasts or adjusts in year 11, here's what happens. It does go to a principal and interest loan, but here's what double kills you. It goes to amortized for 20 years because you've already had it for 10 years. So you will get double hit. And what I mean by that is your payment will likely double, if not go up triple, the amount that you're paying now, depending. So if you are one of these people out there with a home equity line of second, I would encourage you to look at consolidating or doing something with that as soon as possible, because you will get burned on those, and as rates go up, it's really going to be prohibitive. If you have any questions about that, you could always text me, 408-838-9060, or contact me anytime. Email me, joe@𝗟𝗡𝗡𝗙live.com. That is one thing that I want to stress. If you have one of those equity lines, look at wrapping those together into one loan. The second thing is for those people that have been discouraged with the purchase market, those buyers, I'm telling you, get out there. The market is changing. Homes are staying on the market longer. You have a little bit more negotiating power right now, and it's a great time to buy no matter what anybody tells you. Don't listen to your friends, your neighbors, your family. In some cases, all they do is they have perception and they think they know. I'm telling you, now is a great time, and the reason why is a lot of people, things slow down come the holidays, and I've seen some of the best buys and best opportunities for people during the holidays to buy. So when I come back, I'm going to talk a little bit more about that. If you have any questions, a couple things you could do. You could give us a call, 1-800-516-1220. Better yet, text the live line, 402 segments. Great interview with Kris Hudson with the Wall Street Journal. Be sure to tune into that later on the podcast. If you missed today's show, great interview. Kris is always good on. He reports on real estate in general, new construction, home construction, and much more. In the last segment, I was reminding everyone the rates have come down again, and also if you don't know, if you're not sure, check with me, text or call me, email. We have actually a special going on right now through the weekend, and rates are good enough as they are, but we're offering a special to clients for conforming jumbo and FHA purchase, and the pricing's even better, but it only lasts through the weekend. So if you're interested, if you think you need to refinance, or you're in the midst of a purchase, give me a call, check in. You could reach me a couple different ways. Email joe@𝗟𝗡𝗩𝗘.com, or you could use the live text line 408-838-9060. Again, rates are really, really good right now. Take advantage of them, and there is a special on top of that going on for us to offer you through the weekend. So we'll talk a little more about that, and then before I end the show, on the last segment, or what I'm going to do is quickly cover the top, some of the top real estate trends to watch for in 2016. A great article that talks about some of the things to look for in 2016, and it's hard to believe that we are nearing the end of 2015, and we'll certainly be doing that, and that will be soon. We're entering into November here come next week or so. So the second thing I started to talk about was if you have a first and second, I would heavily consider consolidating that first and second. The other thing is, if you are one of those home buyers or potential home buyers, I'm telling you now, between now and the end of the year could be the best time to buy, and here's the reason why. The market has softened a little bit. You're not having a lot of those crazy multiple offers like you will. They're still out there depending, but they're not as, just believe me when I tell you, I work with real estate agents every single day. The market is changing. You're going to have a little more inventory. You're going to have less competition. A lot of people kind of emotionally, physically stay away from the market come holidays. And holidays are some of the best times to buy. So if you're thinking about it, if you're on the fence, and if you're wondering, that's the number one reason. The second reason combined is the good old perfect storm is that rates are at not all-time lows, but they're low as they've been for a while now. We have 30-year money, again, under 4%, depending on your situation. So for those two reasons right there, I would say get out. If you're on the fence or maybe you were discouraged for a while and you stopped looking, I would be out looking again. Find yourself a good real estate agent. If you don't have one, contact me. I have many good real estate agents to recommend as well. And I don't say it often. I do it in ads, but this show is to educate and inform you, the listener. So at any time, anyone out there needs a real estate agent, a financial planner, a CPA, legal advice in real estate, builders, home design, landscaping, I go on and on. Contact me. We have some great teams of people that work with Real Estate Radio Live, and that that I will give you a trusted referral if you need anybody else in those different areas for sure. So contact me at any time if you need any help in that area. So let me dive into some of the trends before we get out of this segment, and I'll finish up in the last segment. Some of the trends to watch for in 2016 are going to be, number one, some of the cities, some of the cities that are really growing. The big thing to look for is suburban properties are really making a comeback. And what I mean by that is, years past there was a sprawling, the idea that let's get this private estate, 10 miles from town, and we could have this oasis, and we could just, really chill out and be away from everybody. But that whole concept now is changing. The value is moving closer to the suburbs and the cities. That's where the value is coming from now. The closer you are to a popular city with all the amenities, restaurants, nightclubs, shops, food, all these different things that are going on now. Most people, and it really doesn't matter. Certainly there's a big push by the millennials, but even the people that are retiring, they are also wanting to be close where they could walk to town, take a bike to town, better transportation, public transportation, all those types of things. Well, you're not going to get all that if you're out sprawled out, 5 miles from town in a big mansion. So there's still a place for those, but the big push, one of the big things to keep an eye on for 2016, the trend will be more towards suburban, people wanting to move closer to town and areas where they could walk. And let's face it, too, most people are becoming more responsible, which is great for the whole green push, right? And what that means is that people want to drive their car less. People want to be more responsible. They want to make less trips. They want to do different things that will be responsible consumers. And that's one of the ways you do it. And you also have a smaller home, and you have homes that are built differently, and some of the energy costs with solar and there's green building now, and there's so many different things taking place. But that is one of the biggest things that is going to be taking place. So also, just the areas, certain areas where the job markets are going to grow are pretty obvious. One of the job markets, strong job markets here, of course, in the Silicon Valley. So we're going to take the last break. I'm going to come back and go through the last few things to look out for real estate in 2016. If you have any questions, text 408-838-9060. This is Joe